Meet Andrew. He works a regular office job and earns a stable salary, but he realizes that savings alone aren't enough. Money should be working for him. He's heard that investing in stocks can generate income, but he feels overwhelmed by terms like brokers, exchanges, charts, and reports. What if I lose everything? Andrew worries. If you've ever had similar thoughts, this guide is for you. We'll go step by step through how a beginner can enter the stock market, avoid common mistakes, and actually start making money. Step 1. Understanding how stocks work. What are stocks? A stock is a small piece of a company. When you buy a stock, you become a part owner of that business. If the company grows, the stock price increases, and you earn a profit. Some companies also pay dividends, a portion of their profits shared with shareholders. How do people make money on stocks? Stock price growth. Buy low, sell high. Dividends. Passive income from companies that pay them. Example, in 2014, Apple shares were around $20, adjusted for splits. By 2024, they had risen to $180. That means if you had invested $1,000 back then, it would now be worth $9,000. Step 2. Choosing a broker and stock exchange. Stocks are traded on exchanges, NYSE, NASDAQ, etc., but individuals can't buy directly. They need a broker. How to choose a broker. Regulation and licenses, SEC in the US, FCA in the UK, etc. Trading fees. Lower fees mean higher profits. User-friendly platform. A simple app is great for beginners. Access to global stocks. Can you invest in foreign companies? Good customer reviews. Popular brokers. Robinhood, E-Trade, Fidelity, Interactive Brokers, eToro. Start with a broker that offers a simple interface and low deposit requirements. Step 3. Define your investment strategy. There are 3 main approaches: long-term investing, buy and hold stocks for years, like Warren Buffett. Dividend investing. Focus on companies that pay consistent dividends. Short-term trading, day trading. Buy and sell stocks quickly for small gains. Beginners should start with long-term investing since it's safer and requires less market knowledge. Step 4. How to pick the right stocks. Andrew opens his brokerage app and sees hundreds of companies. How does he choose? Check fundamental indicators, PE ratio, price to earnings. Lower is usually better, below 20 is ideal. Dividends, 3-5% per year is a good bonus. Revenue and profit growth. Are they increasing over the years? Debt levels. Lower debt means a stronger company. Evaluate the company's future potential. Is the company growing? Does it have a unique advantage over competitors? Is it part of a booming industry like AI, renewable energy tech? Example, in 2010, Tesla's stock was $3. By 2024, it had risen to $200. Those who believed in electric cars early became millionaires. Beginners can start with ETFs, exchange-traded funds, like the S&P 500, which includes multiple stocks and reduces risk. Step 5. How much should you invest? Don't invest money you can't afford to lose. Stocks can fluctuate. Diversify, don't put all your money into one company. Use dollar-cost averaging, DCA. Invest regularly to smooth out market ups and downs. Set goals. Want to save for a car in 5 years? Calculate how much you need to invest. Example calculation. If Andrew invests $200 per month in the S&P 500, historical return of high 10% per year, after 10 years he would have $41,000, and after 20 years, $150,000. Step 6. Where to follow market trends. Andrew wants to learn more. Where should he get reliable information? Financial websites, Investing.com, Finviz, Bloomberg. YouTube channels, Graham Stefan, Andre Geek, Meet Kevin. Books, The Intelligent Investor, Benjamin Graham, The Warren Buffett Way. It's better to buy one stock and learn from experience than to read 100 books and never start. Andrew opened a brokerage account, chose the S&P 500 ETF, and bought his first shares of Apple and Microsoft. Now he invests $200 per month and knows that in a few years, his money will grow. Investing isn't gambling, it's a strategy. The key is patience, knowledge, and staying calm during market dips.